the biggest issue about what's changed over the past 20 years, and it's kind of staring us in the face. It's the damn deficit. It's a damn debt, just way too much of it.
Ed Yardeni explains on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. As Wealth Track marks its 20th anniversary, we are sitting down with some of the financial thought leaders who have been with us from the beginning to hear their perspectives on the biggest changes that have occurred in the financial markets and investing in general. What does it take to be a successful investor in the 21st century? What's changed? What has remained the same? This week's guest is Ed Yardeni, head of Yardeni Research, a global investment strategy firm he launched in 2007. He is a PhD economist, strategist, and Fed watcher, widely followed by investors and the financial press, including Wealth Track. His firm's output is prodigious. It includes a detailed daily morning briefing and comprehensive What I Am Reading list, his compilation of the most pertinent articles from various news sources. He recently introduced Quick Takes for individual investors, a daily summary of his macroeconomic observations. He even does movie reviews. He is also the author of several books. The latest, In Praise of Profits, is dedicated to progressives to help them understand that profits isn't a four-letter word. Another, which I recommended on Wealth Track, is Fed Watching for Fun and Profit, a primer for investors. Now, this is part two of our most recent interview with Yardeni. In part one, we discussed his current economic and market outlook and why he has shifted from bullish, the right call for the last 3 years, to more cautious. You can see that interview on wealthtrack.com. I began this interview by asking him how much have the financial markets changed over the last 20 plus years.
Well, I think we've seen the proliferation of passive investment. We've seen the proliferation of ETFs and just about every investable idea you can come up with. I mean, even Bitcoin now has ETFs. And I think that's been a great positive for investors. Even institutional investors are buying ETFs rather than picking individual stocks. So they're buying sectors. So it's really dramatically increased the choice of assets and ways to manage a portfolio. And I think it's basically been a positive.
So there's a democratization, right,
Yes.
of investing as well, and the fact that there's so much more information now available to individuals that you had to either be a high net worth individual or an institution to get a lot of the research and get information from companies, and now any of us can get it.
Absolutely, and that the internet obviously has made a huge difference to the ability of individuals to day trade, collect information, to watch their portfolios, to try to figure out whether they want to rebalance them or change anything. So I think it's clearly in all of our lives, the internet has been a radical development. Maybe the simple answer is the smartphone. I mean, everybody's got a smartphone, right. And a lot of people watch the markets and watch their portfolios on smartphones. And of course, the financial news. You're part of the financial news explosion, and it's all available just on a smartphone. That you can watch and anywhere. I like to watch the social media. I focus on LinkedIn, and there's a lot of financial information there. I contribute to that information. So my ability to provide research has been expanded dramatically because of the internet. I do share some of my insights with the public. I've always had this attitude that a little bit of a professor that pass along what I've learned that I think is useful and relevant for investors.
Has all of this access to more information made us better investors?
That's a very good question. Some people yes, some people no. People who have day jobs shouldn't be day trading. I think day trading is a day job, and yeah, I think a lot of investors are more informed about what's going on in their portfolios, and if they have a broker or a wealth manager, they're more likely to interact with them and ask what the heck's going on. We do quite a bit of business with wealth managers, and they particularly value our input during bad times, because that's when their accounts are calling them up and saying, why are we in the market? Get me out of the market. And by the way, an interesting story I want to relate to you is that when I ask these wealth managers, well, if your accounts, your rich, wealthy individuals want to get out of the market, what do they want to get into? So, well, they want to get into government debt. And I said, well, why do they want to get out of the market? So, well, because they're concerned about the federal deficit. I said, well, what? They're concerned about the federal deficit, and then the first thing they want to do is buy government bonds and help the government finance its deficit. I think a big thing that's really changed is the country is wealthier. I know that there's a lot of concern about wealth inequality and income inequality, but I think a lot of those inequalities have to do with demographics, so the cohort of different age groups. And the baby boomers like myself, we kind of grew up watching Spock on Star Trek, and Spock said, "Live long and prosper," and that's really the key to life is live as long as you're possible, stay healthy, keep your mind young, and at the same time, don't forget to do some saving and along the way, because if you live long and prosper, your wealth is going to increase, especially if you compound it in the stock market and in the bond market and even in the real estate market.
You're concerned about the market volatility, if you're concerned about the periodic corrections that you have in the market, it is difficult to make up losses, as you know, if you have real losses, with buying government debt. I mean, it's still considered to be a risk-free asset, highly liquid, desired globally, and you're as guaranteed as you can be. You'll get your money back. So what's wrong with buying
Nothing at
Treasuries?
all. Nothing at all. I mean, it's diversification, and you want to have liquidity. You want to have some risk-off assets in a portfolio. And one of the good things about the environment over the past few years is interest rates are now where they should be. I think the bond yield should be 4.5% plus minus 25 basis points, 50 basis points. If the bond yield just stays between 4 and 5%, that's a pretty good return in an environment where I think inflation is going to continue to stay down. So there's nothing wrong with that whatsoever. I think, again, it depends on what age you are. I know a lot of older folks, especially those that are retiring, are concerned about their equity portfolios. But meanwhile, they're doing fine on their bond portfolios, and their home prices are up at an all-time record high. It's the young folks, I think, that really need to appreciate the importance of investing for the long haul in the equity market, because history shows that equities in total return basis, on average, over reasonable periods of time, go up about 10 to 11%, and that's compounding. So it's a great way to get rich as long as you live long.
There is a very active debate. You mentioned the active versus passive investing. One of the guests we've had on since our beginning is Charlie Ellis, who wrote the classic Winning the Loser's Game. He is a big advocate of index investing. And basically, he's saying that one of the changes that has occurred on Wall Street is that it's gone international. Number one, there is a ton of talent. There are PhDs, there are physicists, there are all these trading algorithms that it's impossible for an individual to outperform the market. It is impossible, he says, for an individual active manager to outperform the market. What about that argument?
Well, I think the solution is to combine passive and active management. In other words, a lot of active managers, as I said, are actually using ETFs as ways to be exposed to different asset classes. Rather than trying to figure out individual stocks in India, you buy an India fund. If you don't even want to get that specific, you could buy an emerging markets fund. And so there's so many choices that can make your head spin, and I think that's why individual investors actually do have to turn to managers to help them use the ETFs as a very effective way to diversify their portfolio on a global basis. But I think it's very hard for an individual to do that on their own.
What about active managers who are actually picking stocks? I happened to be at an event the other night where Peter Lynch spoke. Went up on Wall Street. Of course, he retired after running the Magellan Fund for 13 years. I don't know, 30% or something annualized returns.
Yeah, wild.
Are those days over?
Not necessarily. I mean, Warren Buffett's still, doing what he's doing, and he's getting good returns. There are managers that get our research that are doing very well. I hope it's partly because they get our research. People who really focus in on biotech or on technology like cloud computing, people who really kind of understands where these trends are going, some of them have a pretty good track record. So I think you want to look at track records. I mean, there are active managers who consistently do quite well.
You're the author of the Fed Watching for Fun and Profit. Hasn't the Fed's influence grown tremendously as well over the past 20 plus years? How significant are those changes? I
think the Fed's been important all along. I think the Fed was important from the day I started my career in the late 70s, early 80s. I certainly had to stay on top of what the Fed was doing. Everybody's has to be a Fed watcher to some extent in order to be an investor. We have an unusual period, maybe it won't last very long right now, where we're all focusing much more on the White House than we are focusing on what's going on at the Federal Reserve Board. But the Fed still matters a great deal.
What's driving the economy still? Has that changed?
Well, there's some controversy about that. Some people who were looking for a recession over the past 3 years were saying that if it wasn't for all the government spending, we'd be in a recession. And I don't completely agree with that. I think consumers really came to the fore. I think capital spending by private sector came to the fore. But clearly, government spending has been unusually strong over the past few years, and now with the regime change from Biden to Trump, that may be challenged. But I think it does raise probably the biggest issue about what's changed over the past 20 years, and it's kind of staring us in the face. It's the damn deficit. It's a damn debt. I mean, just way too much of it. And you have smart people like Ray Dalio worrying out loud on a regular basis about a coming debt crisis, and it's definitely a concern. It's something we have to deal with. The good news is that deficits, government spending, and taxation and debt, these are all man and woman made problems. It may take a debt crisis to get the politicians to recognize that no mas, this just can't continue to be on this unsustainable path. But meanwhile, things haven't blown up. I've got this bookcase behind me, and the top shelves are full of books from the 1980s about debt crisis and leading to all kinds of calamities. I coined the phrase bond vigilantes back in 1983, and whenever bond yields go up, I get calls from reporters asking me, are the bond vigilantes back? And so I went back and I actually read what I wrote in 1983, and I wrote there that the bond vigilantes are very concerned about $200 billion deficits. And now we're talking about $2 trillion deficits. And here we are still on the planet Earth. Life hasn't come to an end, and quite the opposite. The stock market isn't all that far from an all-time record high. So, one of these days the debt crisis may, finally come to a head, and maybe sooner rather than later. But it can be fixed. All we have to do is, it's simple. All we got to do is raise taxes and cut back on outlays. Doing that politically is not simple at all.
No, it is not. There has been a lot of talk over the last, I'd say maybe 10 years, that the 21st century is going to be the century of China, that China will surpass the U.S. as the world's #1 economy. Hasn't happened. China's has some real problems. What do you think about that thesis?
I don't think much of it. I've been, well, for a while I was saying Japan is the world's largest nursing home operated by the mob. Now I'm saying that China is the world's largest nursing home operated by communists, by Maoists. I think the Communist Party figured out that if they let capitalism work for a few decades, that it might actually lead to more prosperity. So I would say a lot of the prosperity in China over the past few decades has actually been because the Chinese Communist Party let capitalism work. And the problem is it worked all too well, and suddenly there were multimillionaires in China that suddenly represented a new power base, and they didn't like that at all. So around 2013, President Xi slapped it all down and said, no, we're not going to go down this road anymore. And now here we are with him having another change of heart and saying, well, maybe we do need these capitalists to help us grow, but we'll watch them closely. So China's got the demographic problem that was caused by the Chinese Communist Party, and that's the one-child policy that now is leading to a very rapidly aging population, much more so than anyone else. Also, the Chinese Communist Party kind of stood by and let the speculative bubble in real estate occur. The bubble burst and it's creating a huge negative wealth effect. And now the Chinese Communist Party is trying to respond to Trump's tariffs by stimulating consumption. But I don't know that, old people just don't go anywhere and they don't spend as much as younger people with families. So I've been averse to investing in China for all those reasons. That doesn't mean you can't trade China, but as a long-term investment, it's actually been quite poor over the past couple of decades.
What does it take to be a successful investor today versus 20 or 30 years ago? Has it changed?
Not really. Over the years, we've had a business cycle. We've had earnings going up, going down. We've had the monetary policy cycle. And we've had financial crises along the way. I think that the trick for being a long-term investor is to have confidence in your investments. If you're in the United States, if you're invested mostly in American companies, and confidence that the U.S. economy is going to continue to grow and prosper, which it has. There's been a lot of talk about American exceptionalism recently, which of course acted as a contrary indicator, because as soon as everybody became convinced America was exceptional, our stock market started underperforming markets overseas. But you have to have confidence in your portfolio, and investors, I presume we mean long-term investors. You kind of have to stick with it through thick and thin. It's very hard to time the market. Every now and then somebody calls the top of the market, but they forget to tell you when to get back in.
So that hasn't changed.
That hasn't changed. I have to have an opinion in terms of that as well as a strategist. And candidly, I've had some really great calls calling bottoms. I'm still working on calling tops.
Another phenomenon which I've been watching closely, because it actually worries me, and that is the fact that that so much investment money is flowing into private equity, into private credit market, the private loan market.
What is a little unsettling is those markets tend to be illiquid, and it's not clear how prices are actually developed for some of these illiquid assets.
One point you told me that the market is a perma-bull. What do you mean by that?
It's still the case, and maybe more so than ever. I mean, recessions don't last very long, and bear markets don't last very long. So on balance, the market tends to go up by 10% or even 11% on a total return basis. It's done that for decades, with a few scary situations like the 1930s. But that, I hope, was so yesterday. I mean, we just had a lot of fears about a recession in 2022. We did have a bear market as a result of that, but the bear market lasted from January to October, so it wasn't all that long, and there was no recession, and the economy continued to grow, and the stock market came back strongly and made new record highs. The market generally goes up. The scariest times are like recent times when the market's gone down, especially very quickly, and it kind of unnerves people of what's the market telling us about what's really going on. But the market goes up along with earnings, along with the economy.
And we mentioned earlier the levels of debt that we're seeing in the government. There also consumer debt credit card debt is at record highs. Is this an area that is of concern to you? I mean, could this be an area of potential financial crisis?
Back in the Great Depression, there was no such thing as distressed asset funds. I have accounts who are distressed asset managers, and they are very depressed when everything's going well for the economy because they're not getting enough product. They want to be able to buy stuff 25 cents on the dollar, and then they still have enough money to turn these things around, repurpose them, and then sell it back in the marketplace for a lot more. So it's a great business, but it provides a lot of liquidity to clean out things that kind of blow up. I don't do much work on the private debt and private equity area, but I do view them as shock absorbers. In the old days, if the banks did all the lending and their loans blew up, then their capital positions would deteriorate, and they'd have to cut back on lending. Now, if bad loans hit the private debt area, it's just a haircut on somebody's rate of return. It's not a calamity. So that's kind of the way I look at that.
This is the glass half full perspective, which actually I had not heard before. So that's quite interesting. Here we are. You and I have been in this business for decades. You sound still pretty optimistic about the outlook for the U.S. economy and for the markets and the opportunities that are in the U.S. in particular. Is that the case?
Yeah, absolutely. I think that we are in a roaring 2020s kind of scenario. I started talking about that in 2019. It's worked out well for me over the past 5 years. Now I just have to get the next 5 years right. And there will be challenges along the way. There are challenges right now. One of my themes that I've learned over the years is how well the economy and the stock market have done despite Washington, despite crises, despite geopolitical tensions and wars. It's really quite extraordinary. We're not a completely capitalistic system. There's crony capitalism, but there's also lots of entrepreneurial capitalism. And entrepreneurial capitalism it's a great system. And all in all, when you put it all together, we are very good at dealing with the government and coming to work on a regular basis. The Americans are hardworking. The productivity numbers are showing that. We got a fully employed economy, notwithstanding the tightening of monetary policy. I'm very positive on the outlook for the rest of the decade. And now I'm starting to talk about the roaring 2030s. I guess this will all come back to haunt me if everything kind of blows up over the next few years. But I've been doing this for a while, and fears that that's all going to come to an end badly or end badly have been around for the 45 years I've been doing it. And I've taken the other side by saying, well, what's wrong with that story? And so far, so good.
So far, so good, and may it continue. Ed Yardeni, so wonderful to have you again on Wealth Track, and thanks for sharing your 45-year perspective with us. Really appreciate it.
Thank you, Consuelo.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. In this case, it's about retirement and a book to help you do it well. This week's action point is read Christine Benz's book, How to Retire, 20 Lessons for a Happy, Successful, and Wealthy Retirement. Benz is a Wealth Track regular and Morningstar's personal finance guru. As she has discovered over the years, retirement is much more than financial planning. In How to Retire, Benz covers all aspects of retirement with top experts in each area, including herself, in 20 succinct and informative chapters. The non-financial considerations include visualizing retirement, where to live, how to spend your time, nurturing relationships, and aging. The financial ones are also covered, such as investment planning, asset allocation, retirement income, spending, and estate planning. Now, Benz is a financial and retirement planning expert in her own right, but in how to retire, she has assembled a team of her go-to experts to share their lessons in easy-to-read and actionable chapters. In one volume, you now have a comprehensive and accessible How to Retire guide from Benz and her hand-picked pros. Next week, why retired Treasury bond maven Robert Kessler is totally out of the stock market and thinks you might want to be too. Please follow us on Facebook, X, and our YouTube channel. Thank you for devoting your precious time to us. Enjoy your weekend and make the week ahead a healthy, profitable, and productive one.